Banks love lending to tech startups and restaurants, right? That's the myth founders keep repeating. But here's the catch. The industry's banks actually target for business loans, and the strategies winning companies use to secure funding are almost never what you read in the headlines. Today, you'll get the real playbook, and it's not what you expect. The smartest founders know that chasing generic advice is a dead end. Instead, they reverse engineer their funding approach based on what banks are actively looking for. Here are 3 uncommonly powerful secrets, each with a data point and battle-tested example to give your business an edge in the loan approval game. First, break into the hidden growth sectors that banks are quietly prioritizing. In 2025, banks are funneling capital toward industries with proven post-pandemic resilience and high margins, like creative and digital marketing agencies. Since 2018, this sector has exploded by more than 54%, becoming a magnet for unsecured business loans. The pros at scaling agency GrowthX snatched a $500,000 line of credit in 2024, using it to expand talent and acquire high-ticket clients, while many tech startups were turned away. The secret: these companies offer recurring revenue models and low physical overhead, making them lower risk for banks than flash-in-the-pan apps or volatile restaurants. Second, leverage sustainable and ESG-focused business models. The sharpest founders aren't just greening their packaging, they're aligning their entire operation with environmental, social, and governance (ESG) principles, tapping into a tidal wave of bank incentives. In 2025, banks are expected to allocate over $1.5 trillion globally to sustainable financing and green bonds. Take green build construction by embedding ESG metrics into every project and documenting their carbon reductions. They secured a $2 million. Banks are under mounting regulatory and investor pressure to prove their portfolios are future-proof and climate-aligned, and they're rewarding businesses that help them do it. Third, exploit the new frontier of embedded finance. Winning companies aren't just borrowing, they're integrating banking services directly into their platforms, unlocking new funding streams and partnerships. Embedded finance, which lets companies offer loans, payments, and insurance inside their own products, is forecast to drive $230 billion in new bank revenue by 2025. Case in point, a mid-size e-commerce platform, ShopNest, embedded instant checkout loans via a banking-as-a-service provider. The result? Not only did they get access to working capital, but their seamless loan origination funneled extra revenue back to their platform, turning a traditional cost center into a profit engine. Now, here's the analogy that slams these lessons home. Imagine business funding as a high-stakes game of chess. The average founder plays checkers, chasing after the obvious pieces: tech, restaurants, retail, hoping for fast wins. But the all-star founders, they study the whole board, anticipating banks' next moves. They position themselves in sectors with rising demand and low default rates, align with banks' biggest regulatory headaches like ESG, and weave financial services into their own offerings to double their leverage. It's not about playing harder, it's about playing smarter, moving where the capital flows before anyone else even sees the opportunity. Think of it this way, banks are not emotional investors. They're portfolio managers hunting for safety, yield, and strategic alignment. Winning companies treat banks less like gatekeepers and more like business partners with their own KPIs, regulatory headaches, and growth targets. They show up with the right story, the right numbers, and the right strategic fit. Here's the final power punch stat. In the last 12 months, businesses aligned with these 3 strategies, hidden growth industries, ESG alignment, and embedded finance, saw a loan approval rate nearly 3x higher than the average applicant. That's not a typo. While generic applicants languished with a 23% approval rate, these outliers consistently cleared 65% and above. The upside is massive, but only for those who know the playbook. So if you're still thinking of business loans as a one-size-fits-all lottery, it's time to wake up. The banks have already shifted their priorities. The companies winning big in 2025 are the ones who have mapped their business model to the industries, metrics, and embedded finance channels banks are using to hit their own targets. They're not hoping for approval, they're engineering it. Take action, audit your sector, revamp your pitch to highlight ESG and sustainability, and explore partnerships that let you embed financial offerings into your platform. Don't just ask banks for money, offer them the future-proof, risk-mitigated opportunities they're desperate to put on their books. That's how you move from begging for funding to setting the terms. This isn't hype. The data is clear, the winners are already pulling ahead, and the playbook is now in your hands. Don't play checkers in a chess match. The next round of funding is going to those who know banks' real priorities and act before the crowd catches on. Your move.